we've been kind of anticipating and thinking that something like this might happen for a long time. We didn't know what the catalyst would be. The catalyst ended up being uncertainty and regarding tariffs in general. But keep in mind, if we look at the last 24 months, we've been straight up. So we need those 10% corrections to be able to kind of build a new base and then potentially go back to all-time highs. The issues that we're seeing right now, from like a risk off, risk on standpoint, is recently long bond, the TLT treasuries have been outperforming the S&P 500, primarily just because the S&P 500 has been going down as bonds have been remaining relatively flat, and we're still kind of uncertain when it comes to inflation and whether or not tariffs are going to cause any additional inflation. So that causes us to kind of turn to, okay, well, let's look at how investors and institutions are looking at high yield debt versus AAA debt. And right now, high yield is still kind of edging things out. So until we actually see the safe bonds, if you will, start to outperform everything, we think that this is probably a buying opportunity. Now, we have had some metrics that say, hey, maybe it's not a bad idea to take some profits off the table. So I'm not going to judge anybody for taking some profits off the table when they're up probably 50% or more over the last 2 years in their equity portfolio. So we're paying attention. We're still cautiously optimistic. There are a few things under the surface that we're paying attention to, but nothing is broken yet.